All right, welcome to the North County portion of the market update. We got Rusty Williams. I'm Chris Roth, the chapter president. Rusty, a lot of people know you in our chapter. You were president before. You've been on the board a long time. But I think for this, you'll see throughout this podcast, I want to ask a couple personal questions, just get you know more outside of just our brokerage industry. So why don't you tell us a little bit about yourself? Where are you from? Keep it quick, but where are you from? Sports you played, where you live, what you do for fun.
I'm from here. Stuff. Yeah, I'm from right here. I grew up in Vista, California. Went to Vista High School. I went away to college at UCLA, played football there. Got a cup of coffee with the Jets, got cut, got kicked into reality pretty quick, and started with Lean Associates in 2003. Been here since, raising my family here. Love North County, love San Diego as a whole, and there was no way I was going to start my brokerage career anywhere else. So that's a little bit of background on me.
Good enough. All right, man. Let's get into the market. So buyers took a pause. The world's changed really in the last 12 months with interest rates. And obviously you and I have gone through quite a bit of deals falling out of escrow. And it just came to a point where the buyers they took a pause. They just said, hey, a lot of buyers are like, money's off the table. Equity partners bailed. What are you seeing today? Is activity level back? Are they still in the same hold period?
Yeah.
What are you seeing?
Good question. You're right. Things have changed dramatically. I've been around a long time now, and I don't know that I've seen things change this quickly, this rapidly. In the last 12 months, things have dramatically changed. The good news is that there is still demand. There is still traction. There are still deals that are getting done, albeit there is adjustments, right? The reality is that values have come down. Equity has, gotten a lot more cautious. Obviously, interest rates are affecting values. So those are all things that are fluid. What's happening today is probably going to be different than, a month from now. But I think the positive thing is that there are still tenants in the market. There is still demand, albeit it's a lot less. And people are a lot more hesitant to pull the trigger.
But as far as investors go, call it November, December, it was like, we're out. Are you seeing the investors, capital back in the market? Just specifically investors and capital? Yeah,
so to put a little context on that, yes, there were guys that we talked to in firms that said pencils down. That was we had heard that so many times, right? They got sick of hearing pencils down. Basically meant they're not doing anything, and they're not going to buy anything, and they're not going to underwrite, and they're not interested. That wasn't everybody. That was a lot. I would say many of them are back, and now pencils are back in their hands, so to speak. So they are looking, and they are underwriting, and they are, interested, but they're very cautious. And the challenging part is the disconnect between what the investor can pay, is willing to pay with the debt and equity that they have, versus what the seller's expectations are, or what they, thought their building was worth. They think it's worth, and it may have been worth that, but it's probably not the case today.
That's probably the reason for the lack of transactions, my friend.
That would make a lot of sense, right?
So that leads me to my next question. What would you say, general question, percentage drop year over year for investment real estate? Not users, but what would you say? I know it's kind of a guessing game because the transactions dropped off.
I don't know if this is the way you're asking the question, but this is the way I'm going to answer it. The amount of transactions that were happening versus what's happening today, I would say it's got to be at least in the 50 to 60% drop range.
I'm asking the value of investment.
I don't know. I wish I had that silver bullet. I wish I could answer that question. That's a tricky question to answer. We'd have to really spend a lot of time analyzing that data. But, off the total back of the napkin, 20%.
That's kind of my gut too.
Yeah.
Okay, cool.
We're talking gut feelings, right? We're not.
That's all. Yeah, no.
Okay.
We need deals to sell in order to figure that out.
Yeah.
All right. So, how about a few investment deals that have gotten done in our market recently? Would those trade for? What would that look like?
Yeah. So there's been a couple. I won't go in specifics on each one of them. I don't know the confidentiality of it all, but in general, the transactions that are happening, you're seeing value add. There's, everybody's chasing the value add deals, and And the sentiment with the buyers and investors is they need to be able to get to the value, the add part of the deal, within, ideally a year or two. They don't like to see it any further than 2 years out. So the transactions that we do see happen, depending on the real estate and the type of deal, the cap rate going in isn't really that much of a factor. It's more, where can I get the value stabilized to, and my exit on that. So most of the groups that we work with and talk to are in that 6 to 7 range. If it's a outside storage type deal, they're looking high 7s, low 8s.
What about a quality asset that's, let's just say, what would you say is the kind of cap rate going in? Let's assume there's a lot of variables, credit, length of term, all those things. But let's just assume it's a middle of the road property that has a 5-year lease term, standard credit, but it's leased at market today. So that might be a sale leaseback or something. Where would you peg that cap rate today?
So on the low end, for an exchange buyer who's got cash and needs to place that money, high 5s, low 6s is the range. We have a couple exchange guys that'll play in that high 5 range. Institutional groups with equity and debt, they're going to be high 6s. Is kind of what I'm saying.
And do you see that changing for the product type? Like if it's an R&D facility versus the distribution facility, does that change?
Oh yeah. The asset type can have an effect on what the cap rate is. Yeah.
Let's move to the user market. Again, we know pricing changed for investors. Are you seeing a change in the value for the user market?
Yeah, I mean, users aren't oblivious to what's going on in the world, right? They know what's happening. So, when users were looking at deals in the call it $350 a square foot, now they see there are a few more deals on the market. There's more options. Interest rates for them have went up too. They're not the SBA loans are mid 6s. So yeah, the user market, although it's not as dramatic, because the mindset of a user is, well, yeah, I may have to borrow the money at a little more expensive rate, but at least I'm locked in and I know what my mortgage is going to be, and I don't have to worry about my landlord bumping my rent 100% every 6 months. So the mentality of the user is different than the investor, but yeah, I would say that users are much more cautious and aware that the market values are coming down.
How about like activity? Let's say there's a building on the market for 40, 50,000, whatever the size. I don't even get into the size. Has the market thinned for that type of product? The users, is it just as deep as it was 12 to 24 months ago? What do you think?
In general, yeah, the market has thinned out. The pool of tenants and buyers is not as deep as it was. In certain size ranges, it's greater. In certain size ranges, it's not as significant. But yeah, overall, the activity level for all sizes has dropped.
What do you think is going to happen over the next year for a user, just to stay on the user market? Do you think prices are going to come down? Do you think prices are going to remain stable? What do you think?
That's a good question. I really, I wish I could give you a straight answer. That part of that will depend on what happens with interest rates, what the Fed does. Part of that will depend on what happens in the economy, how users are feeling, and the amount of vacancy that we see come online. How much sublease space is going to come out there? How many more buildings are going to come available for sale? So it's a difficult question to answer. It's pretty uncertain, frankly.
How about, let's move on to leasing. What kind of leasing activity are you seeing? I mean, leasing activity was like ridiculous in 2021, early 2022. I mean, we would put a building up, we'd get 4 offers on the building within a month, which was just outrageous. What are you seeing now? What's it look like today?
Yeah, it's a pretty unusual market to have that happen. I think we're getting more into more of a normalized market. Things don't move as quickly as they once did. There are more options for tenants out there. And so we're seeing buildings sit on the market a lot longer than they used to. And the demand and the activity for those buildings in pretty much all segments is quite a bit slower.
How about, so I'm assuming you're seeing an increase in vacancy, an increase in competition with your listings?
Of course, yeah. Yeah, I mean, you've seen that in every size category. We just did the mid-year report, and vacancies have come up across the board.
Have you?
Not dramatically though, right? I mean, it's not like we see a 5% increase. I mean, you went from 1.5 to 2, or
Right.
1.5.
The only game in town to maybe.
Yeah, it's still pretty healthy vacancy rate
right.
considering.
Right.
I mean, very healthy.
Have you seen or do you foresee landlords dropping their lease rates, giving out concessions, something in order to entice a tenant to their building? Or are we just not there yet?
I think we're close, right? I had a good conversation last night with an institutional landlord, and the attitude is, with the amount of competition that's on the market for a specific size range, who's going to do the next deal, and is that deal going to be significantly less? Is it going to be a little bit less? The landlord that goes out and does the first deal is going to kind of set the mark. So it'll be interesting to see, but I do think we're really close to that happening.
I'm gonna ask you again, man. Let's go with the leasing market. What do you think the next 12 months? What's that look like? How's that play out?
I think we're going to see more vacancy come online. I think you're going to see an increase in sublease space. I mean, it seems like every week there's another building that comes out for sublease. I hope that the tenant activity, translates into transactions. That there are, quite a hefty list of tenants that are circling. They're very reluctant to pull the trigger, and my hope is that things start to stabilize a little bit and they feel confident in signing a lease, and that picks up some momentum. But we really need these tenants to pull the trigger, frankly.
Let's move to development. So North County doesn't have much land left to develop. Let's assume a piece of land hits the market. General question, because it depends on a lot of factors, but what do you think it's worth?
$30 a foot. I mean, then that's a total, put your finger in the air, because the reality is it depends on what you can build, what kind of coverage you're going to get. And the biggest variable is, what it's going to cost you to deliver that building. Construction costs are, kind of all over the map right now. And it's going to ultimately depend on what you can deliver, when you can deliver it, and what it's going to cost you to deliver it. And then you back out what you can pay for the dirt. But general rule of thumb, right now we're seeing a few things, and I would say it's in the $30 to $40 range, in that 30s.
One last thing. Give us some sort of pie in the sky prediction over the next 12 months.
Well, I'd like to say, the UCLA Bruins win the Pac-12 and go to the Rose Bowl, but I don't know that that's realistic. So, I'd like to say that, interest rates stabilize. Maybe by the end of the year, early next year, within the next 12 months, we see the Fed pull back on those rates. And, we are in a downturn, but hopefully it's going to be pretty quick and we'll get through it and live happily ever after.
All right, man. Thanks for joining us on the first ever SIOR Market Podcast.